In this session, we are going to understand different kinds of quantitative methodologies that go as a part of the default risk, that go into the computation of the default risk, which is a major component of the credit risk. So we'll talk about different kinds of mechanisms which help me in trying to understand the probability of default of a particular counterparty. So initially we will be talking more and more about structural models, wherein we will start off with a Merton model, which can be used to which can be used to assess the probability of default of a particular counterparty. Then we'll try to understand what are the limitations of this particular approach and how are these typical limitations overcome by the KMA Credit Monitor model and probably a few other approaches. How were they got built under this Merton model base? What are the kinds of modifications that are being done to this Merton model to better assess the probability of default? So these are the models which form under the structural models, which actually use equity of a company to predict the probability of default. So what are the positives as well as the negatives associated with those kind of models? We'll try to have a good understanding on that dimension. Then from the structural models, we will move on to what we call as the credit scoring models, and we'll see what we define as a credit scoring model, different kinds of credit scoring models, out of which we'll try to focus on four of them. One is the Fisher linear discriminant analysis model, linear logit and probit models. Then we will also go ahead in terms of non-parametric distribution, kth nearest neighbor approach, and the support vector machine. These are the four different kinds of models which we are going to talk of while discussing the different credit scoring models. So whatever is the model that we are designing, we also need to know how do I assess the performance of that particular model. So we'll be talking about different kinds of performance measures associated with the model. So different ways in which I can choose which model is the best possible model. So we are talking about the model performance measures. So out of that we would be specifically talking about those performance measures which are targeted towards classification accuracy, means a new record coming up, it has to be classified correctly into a default versus non-default kind of groups. So I want the accuracy of the classification. So I am looking at different kinds of performance measures which help me in terms of classifying a record accurately into default versus non-default. So for that we talk about two major measures, one being the ROC curve and the other one being the Gini or cap kind of an approach. So what are the differences between the two? How do I find the relationship between the two? That's one more thing we are going to target. And similarly, I am looking at the different kinds of performance measures if at all my objective is to predict properly. If my objective is to classify a record into default versus non-default, then I can use either the ROC approach or the Gini or CAP approach for doing the performance assessment of the model. Whereas when I am targeting better prediction reliability, there we are talking about goodness of fit tests, different kinds of goodness of fit tests, So which means depending on my objective, whether I want a classification accuracy or a prediction reliability, I can choose an appropriate performance measure. So we are talking about some kind of different aspects of performance measures. And finally, a simple note talking about how do I select a class of models? What is the kind of flowchart, or what is the kind of step-by-step process that I get in if at all I want to select a specific set of models? So these are the various aspects that go as a part of this particular session. Could be slightly lengthy in nature, but yes, there are lots of models that we are going to talk of in this particular session. So before we get started, here very basic scoring model, if we look at, which have been designed for individual consumer analysis, which are very heavily used for retail loans and probably small to medium enterprises loans. Right there, the human involvement is always costly. I can't do a thorough verification of each and every individual customer for sanctioning a loan which is very small amount. It's not cost effective for me. So we have already discussed that in case of individual retail loans, it's better to go with a scoring model. And what we can expect out of a scoring model is they are good at segregating the good borrowers from the bad borrowers. I'll try to identify a few financial variables, probably the salary of the borrower, the age of the borrower, right? The debt to income ratio of the borrower. So I'll try to select a few important variables, take them as inputs, and use that inputs, build a kind of a financial model, build a kind of statistics based model which will help me in terms of separating good firms from the bad firms. That is what we typically do as a part of the scoring model. And I can apply this to almost any kind of a borrower. Though I use it very heavily for retail loans and SME loans, I can use this kind of a model for almost any kind of a borrower. But much more better than that, for a publicly listed companies, what we see is there is another class of credit risk models which are called as equity based models. To assess the credit risk of a publicly listed company, we can take the help of equity based model, and that equity based models are actually called as structural models, in other way also defined as Merton type models. For the simple reason they have been, this is a model first introduced by Merton based on the concept of Black-Scholes model, but later on different researchers have come out with improvements over the Merton model for assessing the probability of default. So there are different models which are built on the top of the original Merton model for assessing the probability of default, or for assessing or for computing the credit risk that is involved. So that's the reason they are all called as Merton type models. The advantage that has been seen by the industry using these models is they convey early warning information about the particular company. And the case study that is being used very heavily to talk about it was the WorldCom case study, wherein this model was very early in terms of predicting some kind of drop in the price, some kind of increase in the probability of default associated with World Cup. And another major advantage that has been studied about this particular model is it provides a continuous mark-to-market assessment because equity prices are observed on day-to-day basis. We see that this model provides a continuous mark-to-market assessment of the creditworthiness. I don't need to wait for financial statements to be released, let's say every quarter or every year. It's a kind of assessment of the creditworthiness of the firm on the day-to-day basis or mark-to-market kind of a basis. Even that is why this model is able to provide early warning indicators about the performance of a particular firm from the credit perspective. So, but what we can typically say is, though I can use different kinds of mechanisms here, one simple statement that I can still use is even the latest statistical kind of models which we are using for the credit risk, they are far behind the state of art methodologies. So probably this method is much more appropriate compared to the statistical based model which I am using for the assessment of credit risk. So we have to choose which model is a real application for our scenario. Now, let's get started with the structural models, where my intention is to understand the default risk. So these models, as I have already said, they are based on the overall value of the firm. They look at the value of the debt and the value of the equity put together as the value of the firm. And they assume that default is nothing but the deterioration on the value of the firm. And when the value of the firm has gone down drastically in such a way that the value of the firm is much lesser than the amount of debt that they have to pay, this is where we say that the firm is going into default. Because the whole firm itself is having a value which is lesser than the amount of debt that it has to pay. So this is what we are terming as the situation of default. So if I go with that kind of a definition, the corporate securities, I am looking at them as options on the value of the issuing firm. The equity, here when I am using corporate security, I am typically calling it as equity. Equity is being seen as an option on the value of the issuing firm. So we'll see why we give that kind of a definition to equity. We say that equity is a call option on the value of the firm with a strike price equivalent to debt that the company has issued. So we'll try to come out with that kind of a definition slightly later. But let's try to understand. We are using the typical option pricing formula, which is the Black-Scholes formula, to price equity and debt using this kind of a model. So to find out the worth of the equity, the worth of the debt, we are simply using the option pricing formulas. Once I know the firm value as well as the capital structure, which is the debt to equity ratio. So we are simply finding out the value of the firm. There is a mechanism. So I can very well find out the value of the debt and the equity using the option pricing formula. Or if someone has already taken the equity from the market, right? So I can very well find the value of the firm from the quoted equity from the market. And based on that, I can even compute the probability of default as well. We'll take an example slightly later. So I can very well do two things using this Merton kind of a model. I can either find out the value of the equity as well as debt by taking the firm value and the capital structure. I'll use the simple Black-Scholes option pricing formula for that. Whereas on the other side, if I take the market price of equity itself, based on that I get the value of the firm, and based on that I should be able to compute the probability of default of a particular company, right? And today there is a lot of popularity that is going up for these kind of models. Almost it's a market standard in the field of default risk, and there are lots of improvements that have come out because a few limitations are identified as a part of the Merton model. So different kinds of improvements have come out, refinements have come out on the Merton model. So all those are forming an important part in the assessment of credit risk today. So let's get started with the Merton model. So as I have already pointed out, it's an application of contingent claim analysis to the corporate security pricing. So what is that it is happening here? I'm taking a firm whose current value is V, and I'm assuming that there are two sources of financing here. One is equity, which is having a value of S, and pure discount bonds means single maturity, which is a maturity T, and pure discount bond. So zero coupon bonds. Zero coupon bond with a maturity T having a current value of P is other source of financing. So I am not taking coupon bonds here, or I am not taking bonds of different maturities here. That becomes the limitation of the Merton model. When we talk about the limitations, we'll bring all of these things in. But what the Merton model has simply assumed is a firm whose value is V, it is assuming that it is financed through equity whose value is S, and pure discount bonds whose value is P, which are maturing at time T. And the principal that has to be paid at the end of the time T is some K. The principal that has to be paid at the end of time T is K. The present value of that is what we are calling as P. Then it is also making an assumption that at any time T before the maturity, the value of the firm at that particular point is nothing but it's the sum of the value of the equity and the value of debt, which is the debt is purely in one single form, zero coupon bonds which are maturing at time T. Now a few more assumptions have been brought out by this model. See, in general, if I sense that this company is not going to perform well, I can start forcing the firm into bankruptcy. But what the Merton model is saying is the bondholders will not force it into bankruptcy before the maturity of the debt. So if at all they have to force this firm into bankruptcy, it has to happen at time T itself, not before that. Right? That's one assumption the model is bringing out. And so when I am waiting until time T, I am simply looking at that point in time, is the value of the firm, which is VT, sufficient enough to repay the debt. So at that point in time, the debt that has to be paid is the principal itself. So is the value of the time at that particular point in time sufficient to repay the debt? Then we say the firm is solvent, else we say it is insolvent and a default is going to come. So that's a simple assessment that we are doing using this model. And coming to the way the value of the firm is assumed to move, this model made an assumption that it follows a geometric Brownian motion. Means a small change in the value is mu times, there is a drift portion as well as the volatility portion. And we know that this kind of representation dz is nothing but a standard Brownian motion. And we are assuming that the change is because of the drift, which is changing at the rate of mu, drift coefficient, and the standard deviation is sigma times v, dz being a standard normal variable. So this is how we are assuming that the value of the firm is going to change. And as I have already said, if the value of the firm at time t is insufficient to repay the debt capital, then we are saying that the firm is defaulting, which means the bondholders actually will be receiving only VT here, though they have to get D at this particular point because the firm value is not up to the extent of D. The bondholder is going to receive the whole value of the firm and the equity holder is going to receive 0 because the priority is always to the bondholders. So here again an assumption is being made that there is no kind of negotiation that is existing between the equity holder and the bondholder. So we are directly making an assumption that the bondholders are going to receive the entire VT. But in case we are seeing that the value of the firm is greater than that of the debt, then the bondholder is going to receive whatever he was due, which is the amount of debt, and the equity holders are going to receive the remaining of it, which is the VT minus D. So if I am looking at the payoff for the bondholder, it would be the minimum of either K or VT, whichever is smaller. So they would be receiving one of these two, or I can very well write this as K minus of maximum of K minus VT comma 0. Now this is where I can try mapping the options terminology. Okay, K is nothing but the risk free, right, which is nothing but the risk free bond, because K is the principal on the bond. So we are talking about I am going to get that bond minus means I am taking a short position, max of K minus VT comma 0, strike price minus the market price. So this is what we are calling as a put option. So I am having a risk free bond plus a short position in the put option on the value of the firm with a strike price equivalent to the value of the debt of a single zero coupon bond. So that is what is the equivalence of the payoff for a bond investor or for a debt. And the same logic if I am talking about for equity, they are going to receive either 0 or VT minus K, whichever is higher. So this is a perfect payoff associated with a call option. Right, this is a perfect payoff that is associated with a call option. So that's the reason we are saying payoff to the equity holder is similar to the payoff of the call option on the value of the stock, on the value of the firm for a strike price equivalent to the value of the a strike price equivalent to the face value of the debt. And I could clearly see from the bondholder's standpoint, it's a payoff. One, having a riskless bond along with the short position on the put on the value of the firm with a strike price equivalent to the face value of debt. So that's the reason the typical call option graph is what is being shown here as a payoff to the shareholders. A put option, a short position in the put option along with a risk-free bond is what we are showing as a payoff to the bondholders. So that's the way the Merton model has been designed. Now, because everything is going in line with the application of the Black-Scholes formula, and we have also said equity, I can take it as a call option on the value of the firm with a strike price equivalent to the face value of the debt. Now almost every information is there with me. So I can very well find out the value of the equity using the Black-Scholes formula. Again, the formula is used in different ways, but I can very well define in a simplistic way for you. Okay, value of the firm, value of the equity ST at any point in time. Okay, the spot price, which is the value of the firm times ND1 minus the present value of the strike price Ke power minus RT times ND2. Here RT is the time to maturity. So probably write it as T minus T. And here my definition of D1 goes with log. Here S is what we take as VT by X, which is the strike price. I take it as K plus R plus sigma is the volatility of the firm. Sigma squared by 2 times T divided by sigma square root of T. And D2 becomes D1 minus sigma root T. Again, sigma is nothing but sigma V here. So I can very well use this kind of a formula to arrive at the value of the firm, value of the equity. The value of the equity I can arrive at this particular using this particular formula. So N dot is talking about a cumulative normal distribution, and this whole formula is trying to build a relationship between the fundamental value of the firm and its securities. A few important assumptions that are going into this model. At any point in time, the company is having a very simple capital structure. There is an equity, and the debt portion is nothing but one single issue of a zero coupon debt which is maturing at time T. That's a straightforward assumption that is typically coming out. Then value of the firm, it is assuming that it is perfectly observable, but it's not so in real time, right? Because the debt is not that actively traded in the market. So it might very well be possible that the market mark to market value of the debt is difficult to obtain on a day-to-day basis. But this model assumes that the value of the firm is a directly observable element. And as we have already talked about, the value of the firm follows a geometric Brownian motion, which is a log normal diffusion process. So there is no question of any kind of jumps in the model, which means if at all the company has to come to a default situation, it has to come gradually, but it can't come with a big bang. But in reality, we are seeing that within no time the companies can go into default. But this model is assuming that the companies can go into default only in a gradual manner. And default cannot occur anywhere in the middle. It has to occur only on the date of the maturity of the debt, which may or may not be close to reality at all. And whatever I am taking as the risk-free rate of interest are throughout the time and maturity, I assume that it is constant, which is again an assumption that may not be relevant to a large extent because the interest rates keep changing from time to time. And this model does not allow any kind of debt renegotiation between the debt and equity investors. Generally, whenever there is a kind of default that is being sensed, there will be some kind of a renegotiation that can happen between the debt and the equity investors. Otherwise, what happens is the debt investors are going to receive the whole amount and equity investors might end up receiving zero. So there could be some level of renegotiation that can happen between the parties, and a different deal might be struck between them. But here the model is saying no such kind of stuff exists and no liquidity adjustment. So with these kind of assumptions, this model is perfectly able to use the Black-Scholes option pricing formula to come out with the value of the equity. Now, when I use the model from the real world perspective into the real world applications, a few practical difficulties are cropping up. The value of the firm is very difficult to find out because the mark to market value of the debt is generally unknown. So once and we have already made an assumption that the value of the firm is nothing but the value of the debt plus value of the equity plus debt. So this market value is straightforward, whereas this market value is much difficult to obtain. So which means this market value is not that easily observable. And along with that, there are a few elements on the balance sheet like goodwill and off balance sheet elements. They are not that easy to be measured on a regular basis, which means the value of the asset, the book value of the assets is also slightly difficult to work out. And whatever the volatility that I am talking about of the assets, even there it's not that easy to obtain because of the low frequency of the observation. So because of different such kind of scenarios, the Merton model for a practical usage might have its own set of limitations. So there has been some kind of an improvisation that has come over the Merton model, which out of which the KMA Credit Monitor model is much more popular. And practically, if I see, rather than finding out the value of the debt or value of the equity, the Merton model has been more and more heavily used for finding out the probability of default. We'll take an example as to how Merton model has been used for predicting the probability of default and how the KMB model has brought out an improvisation on the top of it. So the KME Credit Monitor also, it is using a similar kind of an approach. The equity based model, which is the Merton model itself, and its intention is also to compute the probability of default. But here it is trying to compute the probability of default using its own set of algorithm, which is more and more proprietary. The reason being, it has found out two major issues that are existing with the Merton model. How should we calculate the strike price of the call? We said the value of the debt, but this value of the debt we simply said as one single zero coupon bond. In case of Merton model, We said that it is one single zero coupon bond. Now this is where the KMA model came out with a kind of an objection. How do I really ensure that this model I can use for different coupon bonds? Different coupon bonds, different maturities, can I use this kind of a model? Now this is where instead of using this D or instead of using this K, which is the face value of the debt at the maturity T as the strike price, they came out with a different mechanism to compute the strike price. They were not willing to use the single zero coupon bond face value as the measure of the strike price for the call option. But that is one point which the KMB model focus more and more on. And further, they have come out with some rule of thumb, which I am going to discuss. Okay, we can go down to see. They have come out with the definition of the strike price at the point of default. They are calling that the strike price at the point of default, wherein the whole debt, whether they have classified the whole debt, different kinds of bonds the company has issued, either into long term or short term. Now, let's say I am choosing the probability of default in 1 year. If I am choosing a time period of probability of default in 1 year, then what we are simply saying is, if the maturity of that particular bond is less than 1 year, they are calling it as short term. If it is greater than 1 year, they are calling it as long term. So they have come out with a model wherein the whole set of bonds of the company are classified either as short term or long term. And based on that, they are coming out with the computation of the strike price at the default point, the value of the asset where the firm is going to default. They started coming out with an empirical result saying that the default value is nothing but the short-term debt plus 50% of long-term debt. If the long-term to short-term ratio is less than 1.5, and this, otherwise they said short-term debt plus this. If you really look at it, this is nothing but short-term debt plus 0.7 long-term debt minus 0.3 short-term debt, which is also a simple way of saying 0.7 times short-term plus long-term. Right? Either it is short-term plus 50% long-term, or it is 70% of the total. They have come out with two different kinds of mechanisms of computing the default. If the ratio long term to short term is less than 1.5, they are simply saying short term plus 50% of the long term is the default value, is the value of the assets where the bond might default. Whereas if the LT to ST ratio is greater than 1.5, they have specified it as 70% of the total. Again, there is no theoretical base to it. It's purely empirical in nature. So they have used some kind of a rule of thumb to compute the strike price of the default at the default point. Then another issue that they came out with is, how do I estimate the drift and volatility of the asset value? The Merton model has typically said that the value of the asset is going to follow a geometric Brownian motion, right? But these people, they don't want to go with that kind of an assessment, because one, how can I make an assumption if it is even unobservable altogether? How can I assume that the process follows a geometric Brownian motion when I am not even able to observe the market values of the asset at all? So they have used some of their proprietary undisclosed methodology to come out with the computation of the volatility. They are not using the volatility which has been used by the Merton model from the equity prices and all. So they are using their own proprietary undisclosed methodology for computing the volatility. Now, this is where I'll try to compare both these models, whether it is the credit monitor model or the Merton model. Let's take one example. Consider a firm. If we substitute it, it becomes more and more easier for us, right? We'll take an example. We'll try to find out the formula. And in case of a Merton model, the probability of default, I can directly call it as n of minus d2. So we'll try to use the Merton model formula. So consider a firm with a market cap of 3 billion. Consider a firm with a market cap of 3 billion. Okay, the equity is coming out as 3 billion and equity volatility of 40%, or I call it as sigma of the equity. Sigma of the equity, I am calling it as 40%. Short-term liabilities of 7 billion. Long-term liabilities of 6 billion. Current value of the assets. Current value of the assets we are taking as 12.511 billion. Firm volatility. So I am taking sigma of the overall firm. I am taking it as 9.6%. If the expected return on the assets R is 5%, find the probability of default as per the Merton model in 1 year. The time to maturity, I am taking it as 1. And here, probably let's say I want to use the default, the strike price at default. Logically speaking, I should have considered a single debt, but of course, let me use based on this model itself. Okay, the long term to short term is what I am trying to find out. I see that this number is less than 1.5. So I can very well find out my strike price at the default, which is nothing but the short term debt plus 50% of the long term liabilities, which is working out to somewhere around 10. Right now I have the strike price. Now I have the value of the firm, the volatility of the firm, the time to maturity, and risk-free rate of return. Based on this, I can find out first of all my D1. D1 comes out as log S, which is the value of the firm, by X, which is the strike price of the debt, plus R plus sigma squared. Sigma squared by 2 times T divided by sigma root T. Alright. This comes out to be my D1. D2 comes out as D1 minus sigma square root of T. Then I'll compute my ND1, which comes out as norms dist value associated with D1, and then I can compute ND2 also using a similar kind of a formula. And from here we are talking about n of minus D2. If I want to find out the probability of default, we say n of minus D2, which is nothing but 1 minus of ND2. So it comes out to be this kind of a number, 1 minus ND2. So the probability of default that comes out through this Merton model is very much coming out as 0.25%. When I am going with the Merton model, it is making a straightforward assumption that the probability of default is somewhere around this. Right, log s by x plus r plus sigma squared by 2 into t divided by sigma root t d1 d2. So the probability of default is coming out to around 0.25%. So that is what is typically being done using the Merton model. But the KMA model looks at it slightly different. The probability of default, it names it slightly differently as the expected default frequency. Even in that case, they are doing a similar kind of a computation. Even in that case, they are coming out with a similar kind of a computation. First, you find out, don't apply the normal distribution, okay? We have got our D2. Look at your D2. Okay, you have got your D2. Don't go with normal distribution assumption. Whatever the D2 that you have got here, call that as the distance to default. So here the distance to default is around 2.8. So it is not relying anything on the cumulative normal distribution. Right, whatever the computation of D2 here, it is calling as the distance to default. They are not relying on the normal distribution because they have felt that the default probabilities that we are computing using the cumulative normal distribution, they are much lower because we are assuming a normality of the distribution which will actually be a thinner tail compared to the reality. So what it is doing is, whatever, okay, this 2.8 is the expected, or 2.8 is typically the distance to default. Now they have taken from their historical data, let's say 1000 firms. And out of that 1000, for each of the 1000 firms, they are finding this distance to default. And what they are simply looking at is, associated with each distance to default, what is the proportion of the firms that have actually defaulted within 1 year? So let's say for those firms which had a distance to default of around 2.8, let's say 2 out of 1000 firms have defaulted. Then what they have come out is, if the distance to default is around 2.8, the probability of default is somewhere around 0.2%. So that is the kind of a mapping that they have done. They have taken the expected default frequency. The way they have come out with their expected default frequency or probability of default computation is, they are trying to match their historical default frequencies recorded in their databases, and the firms are typically classified into those kind of buckets. So that is where they differed. They did not go with any kind of a model. They did not go with any kind of statistical assumption. They have simply took the data from the historical records and tried matching with it. Right. So once they are able to calculate the EDFs, there is even a possibility that they can map it to the rating agency classes also. So okay, if the probability of default, right, probably let's say the rating agencies have given AAA kind of rating to a companies, to a set of companies whose probability of default is, let's say, less than 0.25%. So I can look at all the AAA companies. Okay, what is the distance to default for them? And based on that, I can very well say that the probability of default for them, let's say, is less than 0.25%. Some such kind of a mapping can very well be done in the real world. But of course, there are a few criticisms that come even on this. Whatever the distance to default or the expected default frequency that we have computed is purely based on at the point in time as of today, and we are looking at the probability of default in 1 year, and that's how we have computed or segregated the short term versus the long term. Whereas when we talk about the ratings, they are not for at the point, they are through the cycle kind of approach, and they generally don't look at just 1 year, they are beyond 1 year kind of period. So they may not be like comparing apples to apples. So that's where sometimes people typically criticize that they can't use the EDFs that are obtained from this KMV model for the rating agency mapping, right? But still, conceptually, you can very well understand the same kind of concept. Then, now that we have comfortably understood the equity-based models for default prediction, we'll try to see their usage perspective. One advantage, because the number keeps changing on a day-to-day basis, they can give me early information about the rating migration and default. When is that the company is going into a very high probability of default? When is it shifting from one aspect to the other? So there could be an early information because the equity prices change daily. Lot of things change on a regular basis. So, but at the same time, some negative thing that comes out. Let's assume that the equity markets are falling. What will happen if the equity markets are falling? Just look at the formula now. The equity price has fallen drastically. So it could very well result. Let's take from this example itself. So the value of the equity is going to fall. Value of the equity is falling means, let's say, the value of the firm is also going to fall. Right? So from 12.511, let me make it as 11.511. The value of the firm, purely because the equity market has fallen, let me decrease the value of the firm. Suddenly, because the value of the firm has gone down, D1, D2 has gone down and probability of default has gone up drastically. Right? That is what I am trying to say. Nothing has happened to the debt market. It's only a general fall in the equity market. But the expected default frequency is going to go up. Distance to default is coming down. So the expected default frequency is going to go up. And many downgrades are happening in the internal ratings, which means though the credit quality of those companies was unaffected, but still we could see that because the probability of default has increased for those kind of firms, their credit ratings can get badly impacted. So this is the biggest abuse that comes using this equity based models. The general fall in the equity market can hamper the credit ratings and credit quality of the company. And the other side to look at is false starts are very much possible because of this. Now people see that the companies credit ratings have gone worse, and immediately they start selling their positions in a market when the equity prices are much lower. So they are forced to sell at much lower prices, adding fuel to the fire. The equity prices are going to go down even more worse. The same logic happens the other way. When the equity markets are booming like anything, probably if I make this 13, when the equity markets are booming like anything, even if the credit position is not that comfortable for the company, credit worthiness is not that heavy for the company, the probability of default is going to come very negligible, which means during a bubble kind of a period, none of the models will pinpoint about the credit riskiness of any particular company because equity is there to cover the debt. So this is where a lot of cautiousness is very much essential. And in reality, economic capital, when it is linked to probability of default, which is calculated based on the equity based models, will tend to be more and more volatile. And because of this reason, the top management of the bank does not want to use this kind of a model. And what we typically see is, in general, the equities will be much higher during the boom period and the value will be much lower during the recessionary kind of a period, which means this model is more and more pro-cyclical. And it is also saying because the equities are more and more, equity value is much more during the boom period, it is also saying that the probability of debt will be much lesser, probability of default will be much lesser during this period. So lend more during this period. Whereas during the recession, the probability of default is going to be much higher. So this is where actually we require debt to boost up the economy. But this model is simply saying during the default, during the recessionary kind of an environment, the probabilities of default are going to be much higher. So there is no point in lending during the recessionary period, but that is where the more lending is required to boost the economy back to the original situation. So that's one of the reasons we could see that, or that's one of the major limitations that we could see with the application of the equity based models for the prediction of default. So just to summarize, today there's a lot of popularity that's going around for the Merton type of models. Lot of banks, they have developed their own systems which bring out early warning information from the market variables. They have different ways of estimating the volatility of the firm. Some of them have developed some models based on the equity of the firm. Some of them have come out with implied volatilities from the option markets. So different kinds of ways in which they have come out in terms of estimating the volatility of the firm. So they have done some small tweakings to their original model to suit it to their requirement. And equity based models, they reflect the market's view about the probability of default of a specific users. That's the reason these models are very heavily used in the industry, and they are a very good complement to analyzing the firm's fundamentals. So that's the reason the market is using them quite comfortably. There is a lot of usage, though there are a few limitations which we have observed in the earlier slides, but the market is still comfortably using these kind of models because of a couple of benefits, or complementing the firm fundamental based valuation approaches to assess the probability of default. Now that we got a decent hold on the structural models, we are moving further to understand the scoring model. The reason is the structural models are more and more applicable for listed companies because we are looking at the market value of the equity for them. But they do not extend easily to the smaller and private firms. That's the limitation with the typical equity based model. So that's where we are trying to look at some alternative, and the credit scoring models are someone which are applicable in almost every scenario. Now, the way they try to look at is there are two things that these kind of models talk about. They focus on the prediction of the failure as well as the classification of the credit. So any new firm, they focus on one, finding out the prediction of the failure, probability of default kind of stuff, and two, they also focus on classification of that particular credit into a default or a non-default kind of a category. Today it's one of the most widespread technique that is used by the banks, especially at individual retail kind of a level for processing the credit card applications. Today credit scoring model is the most heavily used one. Even for small to medium term enterprises based lending, still the credit scoring models are the more heavily used kind of ones. So we are going to look at different kinds of mechanisms. Especially there are linear regression based probability models, logit model, probit model, multiple discriminant analysis models, which we are going to look at. Some of the credit scoring technologies that are heavily being used in the industry, they get classified into different such kind of statistical aspects. A few things. Any model that I am choosing, one, it should be more and more accurate. The error rate should be much lesser. So that is how I choose a model. The model should have a parsimony. It should not use hundreds of parameters to finally give me a result. It should use as little number of parameters as possible. What we call them as explanatory variables or independent variables. They should be very limited in number to give me the required outcome. So that's one more important characteristic of a good model. It should produce me an interesting result, which is the non-triviality of a model. It can't give some kind of rubbish as a result. And it should not take years and years to run and give me the result. It should be able to be executed in a reasonable amount of time, and it should be purely based on how frequently or how often I am going to use that particular model. So the model should be very much feasible. There should be a lot of transparency in the model, right? What are the different kinds of relationships between the various data? I should be able to understand it and explain it to others, and where the output is coming from. People should be able to interpret and transparently make some kind of conclusions from the model. So these are the various attributes that are very much essential for any good model that we are developing. And very common set of models when it comes to the scoring aspect. The first dimension is I need to know, we have already said that these credit scoring models do two things. One, they classify the credit into good versus bad, and two, they get into the prediction of the probability of default. Now in this classification, we talk about two different definitions. I want to know whether it's a supervised classification or an unsupervised classification. When I'm saying it's a supervised, we are defining the criteria according to which I want to classify the various risks, the various credits into different groups. Whereas in unsupervised, we are leaving the classification completely to the data itself. The model builder looks from the model. So this classification comes purely from the model, whereas here the classification we already know according to what criteria we want to classify between the groups. And so we are more and more focusing on the supervised classification category itself, wherein we are looking at different kinds of methods that are useful for credit scoring. We are talking about a few front-end models and a couple of back-end models. In the front-end models, we talk about more and more ease of understanding and implementation. So even we can perform it quite comfortably. They have a very good classification accuracy. Wherein we will be talking about two major models called Fisher linear discriminant analysis and the other one being the logistic regression and the probit model. Whereas when it comes to the back end, they have a slightly longer computation time. They take more time to execute, but they have a very high predictive performance. So, which means if my objective is more and more of a classification accuracy, I can look at one of these two models. Whereas if my objective is getting more and more into a predictive performance, though I am going to take more time to compute, I can rely on the kth nearest neighbor based classification or the support vector machine based classification, right? And apart from these also we see different kinds of other techniques like neural networks, pre-induction methods, genetic algorithm. Different such kind of methods can quite comfortably be used. So here in this session we are going to talk about these four different kinds of methods, how they are going to help us in doing the classification and prediction. Though we are not going to go very much in depth into each of these methods, but at least from a functional standpoint we have to understand how each of these methods are going to work. So starting off with linear discriminant analysis. So the objective of this is primarily do a segregation and classification of a big set of data, which are here the borrowers, right? Here I am looking at the borrowers, which is a heterogeneous population. I am trying to group them into homogeneous groups. So probably the homogeneous groups I am calling them as default and non-default. The whole set of population which is having different sets of characteristics, I am trying to group them either into a default or a no default kind of a category. So I am giving a decision criteria and coming out with a relevant decision rule based on which I am identifying the number of classes. See here I have identified, let's say, two classes, default versus no default. I am doing the segregation of the data, right? And with this as the target, I am coming out with a linear combination of explanatory variables. Here for these borrowers, I might take the explanatory variables as age, education level, let's say debt to income ratio or salary, some such kind of explanatory variables I am taking, and based on these I am trying to come out with a mechanism which is going to segregate the default risk from the non-default kind of categories. So here if you understand, just as a notation, if I am saying n is the number of data points, which are the number of customers to be classified or number of borrowers to be classified. P is the number of variables per each data point. So let's say we are talking of these four variables based on which I want to classify the customers. X is a vector of observations, okay, for the customer 1. For the customer 1, what is his age? What is his education level? Let's say a doctorate. What is his debt to income ratio? 4.5. What is his salary? Some 100,000. So this is a vector which we are having for each of the observation. And let's say we are dividing the whole data into two classes. So the C for me is 2. And I'm trying to find mu I as the mean of the variables. So if I'm looking at the mean of the variables in class I. So when I'm looking at the class I, so the default is one class no default is the other class. So I'm trying to find out the mean of age, the mean of debt. That is what I'm calling as mu I. And between the classes, whatever is the covariance that is existing, let's say that is what I'm calling as the sigma. Here my objective is to separate the two classes W1, omega 1 and omega 2. Probably I'm calling omega 1 as good borrowers and omega 2 as bad borrowers. Now the simple way is I am combining a linear combination of the explanatory variables. Here that particular combination I am going to choose, which will create the maximum distance between the two classes. So I am taking the classes as no default and default. I am using that linear combination of each of those explanatory variables where the distance between these two classes is the maximum enough. So this is where I am talking about mu1, which is the mean of the first class, mu2 the mean of the second class, and I am multiplying this entire process with the transpose of the WT. Right, I'm looking at the weights. So I am taking appropriate weights, transposing that, doing a multiplication square, and I am dividing it with the WT. WT is the transpose and sigma is the covariance and W is the original vector. So overall here it is coming out as the variance and here it is coming out to be something like a covariance. Numerator is coming out as the covariance, denominator is coming out as the variance, and this is the one I am trying to maximize. And of course I know that if I have to maximize it, I am differentiating it with respect to the weights, because the weights are the ones I am supposed to find out, and I am differentiating this with respect to the weights and setting equal to 0, which means the weights are typically coming out as the covariance inverse matrix, the inverse of the covariance, and I am multiplying it with mu1 minus mu2. That is how I am getting my matrix of weights for each of the parameters. So this is the mathematical way. Of course, we have software tools or statistical packages which are going to perform this activity for us. So all I need to know is, if at all I have to classify the risks into a good risk versus a bad risk, I am using the Fisher linear discriminant analysis, and the typical procedure of the same goes in this particular manner. And any new record or any new customer X that is coming up, I'll be assigning them to W1, omega 1 or omega 2, depending on whether I'll choose some kind of a cutoff point alpha here. So depending on whether W transpose times X plus alpha is greater than 0 or less than 0, I'll try to push that particular risk into good borrower or a bad borrower kind of scenario. So the alpha, there is no mathematical or anything, it's purely chosen by the user, right? Now this is where even the software tools are developed today to understand this process. I don't need to do this entire kind of maximization and all on a manual basis, right? When I refer to statistical packages like R or SPSS or SAS, these are all built in, which can help me in doing this process in a full-fledged manner. And here when I am doing a parametric understanding, right, just assume that S of X is a score function which is W transpose X plus alpha. Once I have chosen the alpha, the whole Fisher's rule is a clear-cut segregation for W1 and omega 1 and omega 2, because this is the formula that is going on for the classification of omega 1 and omega 2. But it is only doing the classification, it's not providing the probability of a particular person being belonging to group 0 or group 1 or default or non-default. Now this is where we talk about a slightly different model. If at all my intention is to come out with probability of default, try to come out with whatever, okay, W transpose X plus alpha, take that, right, that is Sx, take that value as the probability of belonging to group W2 given X, and based on that do a linear regression, and that can help me in terms of obtaining the probability that a particular risk or particular borrower can belong to a default class, and 1 minus of that will tell me the probability that he will belong to the other class. So you may try to, if it goes above 1 or much below 0, try to make some adjustments so that the whole data fits into the 0 to 1 kind of an interval, because a regular linear regression may have values much above 1 or much below 0 also. So some kind of an adjustment to the same needs to happen so that the whole value fits between 0 to 1. But just to understand as a process, linear discriminant analysis is a very good scoring model which can classify based on a set of variables whether a particular borrower falls under the good risk or a bad borrower kind of a category. Similarly, a small improvisation over that linear discriminant analysis itself comes out with logit and probit. If you look at it, the same S of x, which was the score, which we have used W transpose X plus alpha. Here, if I am able to write it as the probability of X given omega 1 divided by the probability of X given omega 2. Based on this, a slight working around mathematically, I can very well come out with the probability of omega 2 given X, which comes out with this kind of a formula. And here I can very well make an assumption that beta is a constant, which talks about the relative proportion of the firms in the two classes, because if I do this, all I am ending up with is 1 by 1 plus e to the power of W transpose X plus alpha plus log P of omega 1 divided by P of omega 2. This entire thing we have called it as beta, which we simply said as alpha plus log probability of W1 by probability of W2, which is coming out as a constant, which is talking about the relative proportion of the firm in the two classes. The only difference is the only difference which we are talking of here is the probabilities. We are following a logistic law, and that's the reason we are calling it as a logit model. Otherwise, I can make it follow a normal distribution. In that case, we call it as a normit or a probit kind of a model, which will have a thinner tail compared to the logit model. But when we are doing the estimation, either of the methods can very well be used. They don't make a big difference in the real world estimation, right? And the assignment to the classes, the default versus the non-default, in any of the mechanisms, the process remains the same. I look at S of x, which is comparison with W transpose X plus alpha. If it is greater than 0, I'll assign it to a group W1, omega 1, or if it is less than 0, I'll assign it to the group omega 2. So that process will still remain the same as what you have done in the linear discriminant analysis, right? And estimation of the parameters is performed by the maximum likelihood approach. Now, all we are saying is we just need to be aware that we can use these kind of models for classification, because there are software tools and packages, statistical packages, which are available, which can perform this kind of a process for us. So just an awareness of the availability of these tools for this particular purpose. That is one place where we have to be comfortable with. The same way goes with a non-linear logic, especially if we are assuming that the variables are not linearly related, there could be a non-linear relation, then we can do a slight more different transformation where I can, here if you see, instead of using W transpose X plus alpha, we are saying W transpose T of X plus alpha, right? And T of X we are going with a non-linearity here, xi to the power lambda I minus 1 by lambda I, where we are talking about a convexity parameter for lambda I. So there could be 2, 1.5, 1.8, 2.5, whatever it is. It's a convexity parameter. And based on this, we are trying to arrive at different kinds of transformations, and that is what we are calling as Box-Cox function. Similarly, I can have a quadratic logic wherein instead of just taking x, I'm also focusing on x1, x2 kind of logics. So we can have different kinds of mechanisms, but at the end of the day, either it's a logit or a probit kind of a model, but it need not be considering only the linear transformations. Non-linear quadratic can very well be used. But the advantage is the non-linear kind of stuff is we have more parameters now, which means there is a possibility of coming out with a much better fitment and a much more better predictive model compared to the typical linear models. Yeah, all these are present as a part of sophisticated statistical packages. So we really need to have an understanding of the usage of them so that we can run them comfortably on the statistical packages. Then, moving on to the third model, where we are looking at the backend based models which are computation heavy, the non-parametric discrimination model, which we also call as the k nearest neighbor approach. It is something which performs very well once we know a Bayesian classifier. The typical way it works is between the various, let's say we have, I want to classify a company X, right? I really want to classify a company X. So it is trying to look at the similarities between this company and a set of reference patterns from the training set. Let's say I already have 12 companies or 15 companies which I have taken as the reference. And now, and I want to classify the 16th company either as good or bad. So what it does is, it tries to look at the patterns of this X with respect to all these 15 companies, and based on that try to do a classification whether it falls under the good or bad kind of a category. And a pattern is classified to a particular class, so it will be classified either to good or bad based on the majority of its k nearest neighbors. So it will see which of how many neighbors which are close to that are good and how many of them which are close to that are bad. Depending on which number is more, it will do the classification of that particular of X into that particular group. So it's as good as going with the English proverb, judge a person by the company he keeps. Depending on who are the kind of friends the person is having, you can very well assess the behavior of that particular person. You can very well assess the quality of that particular person. The same logic, depending on what kind of borrowers are there in the neighborhood of this selected borrower, you can very well assess the credit worthiness of this particular borrower. So just for example, let's look at it like this. I want to classify good and bad firms using two variables, ROA and leverage. So I have taken ROA and leverage as a X and Y axis, and I am plotting different firms under the ROA. Under different ROAs and leverages, I am plotting different kinds of firms. So some of them are good, some of them are bad. So the bad firms are highlighted in black, the good firms are in white. So that is what we are calling as my training sample. Now I have taken a new firm which is identified with a star, which I really want to classify as good or bad. And I have chosen the 6 nearest neighbor approach. K nearest neighbor is here, I have chosen it as 6 nearest neighbor approach. So what I am simply looking at is identifying the 6 closest firms to this particular firm. So these are the 6 firms which are closest to this particular firm. Out of this, I am seeing that 4 of them are falling under the good category and 2 of them in the bad. Because maximum number of firms are in the good category, the new firm which I am considering to evaluate is being classified as good, because 4 firms in the neighborhood are good and only 2 firms in the neighborhood are bad. This is how we use the K nearest neighbor approach for classification of the firms or classification of the borrowers into good or bad kind of category. This is how the approach typically works in simplicity. Now, how do we really identify the distances like this? I mean, here we are saying we have taken ROA here, leverage here, and based on that we are seeing the closest neighbors. But if there are more number of variables, what is the way I really identify which are the closest ones? And that is where we are talking about the distances, which are, well, I'm looking at the distances to each. If you look at xi's are the numbers for the firm which we are using, and yi's are the similar numbers for the training set. And of course, let's say there are p parameters that we are using. So for each of the parameter, so for age, right? So the age, what I say is, what is the age of the customer whom I am taking, and I'll also take the age of the entire training set, right? The age of the training set that I am considering. I'll do a square. I'll do the square root of it. I mean, I'll add up all of them like that. First of all, right? I'll do the age, the square of the distance. Similarly, I'll be doing the salary for the person versus the whole set, square it. So I take the summation and finally I take the square root of it. This is what we are calling as a Euclidean distance. And I am finding out the Euclidean distances for each of the firm from each of the variables of the training set. So because I have to do this much of calculation, it becomes very time consuming kind of a process. Especially when the sample size is much larger, the process becomes much more difficult. And the choice of K is also very important, because the larger is the K that I am choosing, there's a lot of valuable information that might get lost. But at the same time, if I am choosing it too small, it becomes very unstable. So that's where there is a rule of thumb which says try to choose your K based on n to the power of 0.25. So if my n is 16, then probably choose K to be around 2. If n is 81, choose K to be around 3. If n is around 256, try to choose K to be around 4. So try to be more or less closer to these kind of numbers which will help us in doing a much better kind of classification. Right, the number of neighbors you can choose more or less based on this benchmark, but that is not again, that's not a rule to be chosen. And then we have another mechanism called support vector machines. So here it does the classification using a best hyperplane approach. It does a good performance, and it has a parsimony in terms of parameters. It uses very little number of parameters. Here we can talk about linear support vector machine or even a non-linear also, right? What I typically do is we look at the data which is linearly separable. So if I plot the data on a plane, I'm trying to draw some kind of a line which can separate the good from the bad. So if the data is linearly separable, I can use many ways to perform this segregation. I'll see whichever is the line, the distance to the two parallel hyperplanes on each side is the largest. I'm putting two planes which can do the segregation much better, and the distance between the two planes is the largest. So that kind of planes I'm choosing. So the point X on that best hyperplane, if I say that this is the best, I am choosing two lines here, two planes here. So whichever is satisfying this equation W transpose X plus W naught equal to 0, which means the best hyperplane whatever I am doing, best separating hyperplane, need not provide the tightest separation rule. It is actually provided by these two parallel ones which are separating it. And if the data is not linearly separable, I can use slightly modified kind of a formula in terms of classification rule. Now, regularly we were doing the classification as WTXI plus W0. If it is greater than 0, we are classifying it under W1 category. Otherwise, we are classifying it as a non-default or default kind of categories accordingly. But when there is a kind of non-linearity, we are even adding up a kind of fuzziness, right? A positive parameter that measures the degree of fuzziness of the rule. So by adding it, we are trying to accommodate the non-linearity also. A few important points that we need to understand using the support vector machines is it uses the best hyperplane kind of an approach to really separate the good from the bad kind of customers. Now that we have used different kinds of models, we talked about linear discriminant analysis, we talked about logit, we talked about probit, we talked about k nearest neighbor approach, we talked about support vector machines, we have talked about different kinds of models, one to classify a particular risk and two to predict the probability of default. These are the two things which we have taken for model performance. Now this is where we are focusing more and more to assess the scoring models. I need to have, now these are so many models, I need to have some kind of a performance measures to assess these scoring models. Because if you look at a bank, if it has used a flawed model, a wrong model, and that model consistently underestimates the risk, the bank is very much at a risk. The stability of the bank is under a question mark. So we really need a better measures which can assess the performance of each of these models. And that is where we are coming out with different kinds of decision rules. So I can talk about minimum error decision rule. I want the classification to happen in such a way that the error is very, very minimal. Look at this scenario. If I want to classify a firm where I really don't have any kind of information, except that the probability that a firm will go into class 1 or the probability that it go into a class WK is known. Now the best way to assign a new risk, the best way to assign a new risk is to that most probable class. So whichever is the one that is having the highest probability. With an example, if I have to say, okay, the probability that a new risk Xi will go into a group WI, W1, let's say is around 0.75, and the probability that it will be classified as default, which is W2, let's say is 0.25. then the best, if I don't have any other information, the best way to put it into a group is I'll put it directly into W1, because there is a 75% chance that it belongs to W1. Right? If only information that is available is there are 2/3 of good firms and 1/3 of a bad firm, which means the probability that it will go into a good is around 0.66, and the probability that it will go into the bad is 0.34 or 0.33. Then there is a good chance that I will classify this xi into good itself, because there is no other information that is available with me and I want to minimize my error. So I'll definitely classify it into good. That is what we are calling as a minimum error decision rule. But if at all I am having some data about the explanatory variable, which means I am typically looking at the probability that it belongs to group 1 given x, right? Then I want to maximize this kind of a probability. Right, I really want to maximize this kind of a probability to classify it, because this probability is something that is known. And how do I find this out at any point in time? I can use the Bayes criteria. Right, I really can talk about the probability of x given w1 multiplied by the probability of w1 divided by the probability of x. So this will give me, using the Bayes theorem, this will give me the probability, right? I can find out each of the probabilities here, the probability of W1 given X. This is what we call as posterior probability. So I can try to find out the posterior probability, which comes out as the priori probability, which was probability of W1 divided by the evidence, and I multiply it with the likelihood function. So the likelihood function is the probability of x occurring given wi. Now using this we can find out the conditional probability, and my intention there is I'll find out wherever the conditional probability is the maximum, and I would assign the risk to that particular group if I have specific information about a particular group, because I want to minimize my error altogether. So I'm going with the conditional decision kind of a rule, where I want to look at the probability of x given wj. Right, I'm looking at maximizing this probability of x given wj multiplied by probability of wj, which is what is coming out. Probability of, I'm looking at the maximum value of probability of x given wj multiplied by probability of wk, whichever is the one that is going to be the maximum, I am going to allocate to that class. So basically I am looking at this kind of a computation. This is the likelihood multiplied by the probability of occurrence. So whichever one is having the highest, I will be classifying a particular variable or particular risk into that particular group using the minimum error decision rule. But on the other side, I can even apply a minimum risk decision rule, where my intention is to minimize the expected loss or the risk of misclassification. I don't want to do wrong classification, because from the bank's perspective, look at the two kinds of risks that they are taking. A person who may not default, you may classify him as a default. Your model is classifying him as a default. So you are not lending to that person. Fair enough. Or a person whom your model said he will not default, but he has defaulted. Because your model said he will not default, you have lent to him and he is defaulting. This is what is a severe loss to the bank. This may not be a big loss. Okay, you have not given the loan to that person. That's it. You did not lose out anything bigger on that. But on the other one, you have lost it much bigger. So there is a more damage to the bank to lend to a company that is falsely considered to be sound than wrongly avoiding lending. So here, okay, you have lost a customer, fine. But here you are losing money. The loss is very high in this case. So I have to really differentiate between these two. I should minimize the risk of misclassification here. And that is what we typically go ahead in terms of minimizing. For that, we have a good rule called Neyman-Pearson decision rule. Especially if I am talking of two class problems like the example here, good and bad. There are four kinds of choices that come out. The firm is actually bad, means it is defaulted, and you have classified it also as bad. So we have done it as a right decision. The probability is here I am looking at two different errors. E1 is a type 1 error, E2 is a type 2 error. So when I am saying type 1 error, we are talking about we have classified something as good. Our model said that he will not default, but he has defaulted. That is what we are calling as a type 1 error. The model said that he is going to default, but he has not defaulted. That's a type 2. Type 2 may not be a severe problem for the bank here because they might have omitted the loan for him right at the beginning. But type 1 is a very serious problem. So, okay, here we are trying to see these four classifications. The firm is a bad and you have classified it as good, which means you have wrong detection of default first type 1 error. Similarly, you have classified the firm is actually good and you have classified it as good through your model, which means you have taken a right decision. But the firm is good and you have classified it as bad, so you have not lent to that firm. It's a kind of a false alarm. You may not lose out much bigger to that. Now, the intention of the Neyman-Pearson rule is try minimizing the error type 1 and type 2 errors, or within that try minimizing the type 1 error because that is more severe kind of an error, with type 2 error remaining constant. So generally what happens is if your type 1 is decreasing, type 2 can increase and vice versa. But the Neyman-Pearson rule majorly focuses on minimizing the type 1 error, keeping the type 2 error constant. So that is one more measure that we can look at. And there is a mini-max decision rule also that can come out where I am looking at whether it's an error or a risk. Whichever is the maximum error or a maximum risk, I want to have the minimum most value possible. That is what we are calling as a mini-max kind of a decision rule. So we have different kinds of decision rules which are operating. Either I can go with the minimum error decision rule, or I can go with minimum risk of misclassification kind of decision rules, Neyman-Pearson decision rule, or even the mini-max decision rule. So some rule which I say this is the basis for classification. On this basis, the data is getting classified into the different groups, good and bad. Now, once our model is built, right? So once our model is built, either using the discriminant analysis or whatever is the approach, let's say our model is being built. Now, I am looking at the performance measures of each of the models. So first thing we'll focus on classification accuracy, and then we will also at a later point we'll be focusing on the prediction accuracy of the model. So from the classification accuracy perspective, we are targeting the ROC approach. So we'll compute what we call as the ROC coefficient. It's a very straightforward stuff. Okay, we are talking about a scoring model where we have built that model with n firms, out of which d of them has defaulted, right? And we have a score SI. The probability of default is PI for each firm I. And we have chosen a cutoff level T So if the probability is greater than that t, the probability of default is greater than that t, we are saying that the firm is considered bad. And if it is less, so this is what we are calling as the classification rule. If the probability of default is greater than the cutoff, we are calling it as bad, otherwise we are calling it as good. So again, the four kinds of possibilities can come. You have called it as good and really it is good. You have called it bad, really it is bad. You have called it bad, it is really good, and vice versa. So you have classified it as good, but the person has defaulted. That is the type 1 error. Now in this, what we are trying to come out with is number of firms correctly and wrongly classified as bad. That is what is our interest here. Those firms that our model has predicted as bad. Right? I am interested in those firms that our model has predicted as bad. So what are the two? You have predicted it as bad, but in reality they are bad. In reality they are good. Right? Your model is wrongly classified as bad, but in reality they could be bad or they could be good. Right? If they are bad, means the company has really defaulted and you have also classified it as a bad, which is purely an indication of accuracy. So which is what I am calling as the hit rate. So your firm has correctly classified it as bad divided by the number which are classified as bad, defaulted, the actual defaulted. So this is what we are calling as the hit rate. And here we are calling wrongly classified as bad. Now I have n minus d firms which have actually not bad, which are actually not defaulted, but you have classified them as defaulted. Right? You have classified them as defaulted. So this is what we are calling as the false alarm. In reality they did not default, but out of them you said though they are good, you have classified them as bad. That is what is a kind of false alarm. So we are trying to compute CT and HT is the kind of hit rate, FT is the kind of false alarm rate. So we are trying to find out both of them. And what the ROC is doing is, I'll take hit rate versus the false alarm rate. So I'm taking the false alarm rate on the x-axis, the hit rate I'm taking on the y-axis. Right? Now, hit rate I am taking against the false alarm I am taking on the y, and hit rate I am taking on the x. Now the steeper the curve, this is what we are calling as the ROC curve. The steeper the curve is, the better it is. Now look at the curve. Let's say if I am talking about this, right, which is like the false alarms and hits more or less are uniform. Right, which means there are good number of wrong alarms and there are a good number of hits. The model is not that effective because I should have more number of hits. If my model has to be good, I should have more number of hits and less number of false alarms. So the lesser the false alarms and more the number of hits, I call that model to be a good model. So the more and more steeper the curve is, I define it to be a much effective kind of a model. The more and more flatter it becomes, I say that the model effectiveness is getting lost. And if you see that if the model is more like this, straight and horizontal, which means the false alarm is almost close to 0, whereas the hit rate is almost close to 1. That is what we consider as a perfect model, but in reality my model may not be that perfect, and that is where I may be looking at somewhere in between the completely uninformative kind of a model and a perfect model. That is where my scoring model typically lies in. So the steeper the ROC curve, the fewer false alarms are going to come up, which means the correct detection of the bad firms is typically happening. So we know that this is a perfect model which goes straight up, and whichever is diagonal, we see that it's more and more like a uninformative model, a random kind of a model where the model is not doing any kind of a good job. And the real credit scoring models will be somewhere in between the perfect scoring and uninformative kind of a model. We can also look at the ROC curve with respect to the minimum loss or minimum cost kind of stuff also. If you look at this, this is the model that we have plotted, right? And I am taking the fraction of all the firms and I am taking the fraction of the defaulted firms, right? And I am trying to draw a kind of iso loss kind of function where which are having the slope of the probability of W2 divided by the probability of W1. What we see is that when I draw this kind of iso loss kind of function, right, where the slope is probability of W2 by W1. So on that particular line, everything corresponds to the same loss. And all I want to see is the minimum loss will be at the tangency of the RO curve and the lowest iso loss line. So I'm trying to draw these, whichever is the one that is a tangent here, this is where we are trying to get the minimum most loss. Right? The loss is going to be minimum by using this kind of a mechanism. And any area that is below the ROC curve is widely used as a measuring the performance of the scoring model. So that's how I can use. And here the most important part for me is the B and C, which I'll use at a later point. We'll try to fit in the equivalence between B and C, or we'll try to use B and C along with the next model that we are going to compare, and based on that we can try to make some conclusions on the top of it. But ROC, which is used for performance measure targeting the classification accuracy, works in this kind of a mechanism. But if you look at a few important things, ROC is focused on rank ordering. We are looking at ranking the stuff. We did not take any absolute value here. We are talking about the fraction of the firms defaulted. So we are only doing the ranking kind of stuff. So it's purely to deal with the relative classification. But in reality, if all of them are equally good or equally bad, there could be a possibility of underestimation of the risk also. So in reality, there could be an underestimation of the risk, but ROC could still be more and more comfortable because it's the best among the worst. So that is the kind of mechanism, because it's purely a relative kind of an approach and absolute probabilities of default and all are not being considered. The classification is purely relative, not on an absolute scale. And if you see, the ROC as a measure will not be that accessible if the class distribution is skewed heavily. And in our kind of an example, when I am looking at non-default versus default kind of firms, these numbers are much smaller compared to this. Right? The population is much smaller compared to this, which means there is a lot of skewness that is very much possible, which also tells us a kind of an indication that ROC kind of an approach may not be a perfect fit for these kind of models. But however, we do use them. That is where we really need to understand the limitations of the model so that we can do the interpretation in a much better way. Similarly, the next approach that we are talking of for classification accuracy is the Gini coefficient, or the CAP kind of a model. CAP is what we are calling as cumulative accuracy profile. So here I am looking at the consistency of the prediction to rank the observed default. What we typically are doing is we are sorting the firms. right, in terms of the default probability that is produced by your scoring model. Whatever is the probability of default that your scoring model has produced, we are simply sorting the firms in the descending order. So we are talking about the fraction of all the firms and the fraction of the defaulted firms. And the vertical axis, I'm taking the fraction of those firms which have defaulted, fraction of those firms, all the firms. Now this is where I'm talking about a point which is the ratio of the defaults to the total number. Right now, if I'm looking at the fraction of all the firms, this is the fraction of all the firms, and this is the fraction of defaulted firms. If I'm getting this, it's a kind of a perfect model for me, because when I'm talking of d by n in the actual number of, because for these firms the probability of default is going to be on the higher side. So at d by n, if in reality I see that actually d by n firms have actually defaulted, right, the whole 100% of the firms have defaulted by the time your model has reached d by n, then it means that the accuracy of the model is perfect. But by the time it reaches d by n, only if this proportion of the firms have actually defaulted, then it means the accuracy of the model is not that heavy. So that is where we are calling it as an uninformative model. And your scoring model may be somewhere in between the two. Just like the way we have used the ROC approach, we can use the Gini approach. The only difference is I am looking at all the firms from the riskiest to the safest, and in reality how many of these firms have defaulted. So this is based on your prediction. I'm going with the fraction of all the firms from the riskiest to the safest, where the probability of default is higher to the lower, and I am looking at in reality how many of those firms have actually defaulted. That is what is giving me the accuracy of my scoring model. Again, the more and more the steeper the curve is, the better is the model, even with the cumulative accuracy profile kind of an approach. A perfect model, again, from 0 to d by n. So there could be a kind of a straight line here. So it's almost steeper, the steepest that is possible. And an uninformative is the one that is going more and more with a 45-degree curve, right, which is more and more tangent, which is more and more diagonalistic to that particular curve. And as an assessment, we are computing what is called as a Gini ratio, where we are taking this area, which is E, which is the steepness of the model, anything that is above the model, as a proportion of the total. So if E is much higher out of the total, right, probably the model is somewhere here. If the model is coming like this, E is much higher compared to F. So the steepness of the model is typically coming down, right? So if I am taking F divided by E plus F, F is a very small value here, right? Because anything above the model is E, below the model is F. So the Gini coefficient I'm creating by F by E plus F. So if F has to be larger, right, look at it, if F has to be larger, E has to be very, very small. So which means the curve has to become much steeper. So if F is larger, G is going to be larger, and that is what we are talking about, the better performance of the model. But again, even this is purely based on the ranking, because I am taking the proportion of the firms which have proportion of the firms in the risky from the riskiest to the safest, and we are talking about the proportion of the defaulted firms. So it's again a kind of a relative or a ranking order kind of a model, And it is highly dependent on the sample on which the model is calibrated, because if the sample is changed from 100 to 200, probably the shape of the model could very well change. And if my sample does not have any kind of a default, then it's as good as Gini coefficient is 100 itself. So this is where it becomes more and more sample dependent kind of a measure. And on the other side, if I have to find out the relationship between the two, you look at the area under the ROC, right? Here, if I am looking at B and C, if I am looking at B and C, which is more and more to do with the false alarm and the model, and I am calling the summation of that as A, and here I am looking at E and F, what we typically say is, if A I am taking as B plus C, which is the area under the ROC curve, Gini coefficient or the accuracy ratio, if I take it as per what we have found out in the earlier formula, F by E plus G, we always get an equality saying G is nothing but 2 times A minus 0.5, right? And this will come when the cost of misclassification are the same for type 1 and type 2 errors. And only in that case, both ROC and CAP curves, they convey exactly the same information. But what we generally see is ROC is much more general than CAP, because it allows for different type 1 and type 2 costs to be used. And CAP is more informative, is more and more valuable if the misclassification costs are equal. But if they are different, it's very much necessary to depend on the ROC itself. And even the defaulting subsample, where I see that if the sample is having a zero default, then probably it's nowhere reliable to use this model at all. Then in that case, it's better to rely on ROC itself, ROC approach itself. But wherever I am seeing that the defaulting subsample is compared with the non-defaulting kind of stuff in the real world, then I can very well rely on the CAP curve. And typically from the banker's perspective and investor's perspective, we see that they are very much risk averse. They don't want any kind of type 1 errors cropping up. So because of that, their costs of misclassification are always different for type 1 versus type 2 errors, which means I can't directly use CAP model as an effective model for the credit scoring purpose. And ROC is much broader because, as I have already said, the misclassification costs, it actually helps us to take it customizedly, and it does not consider both of them have the same misclassification kind of cost. But looking at both of them, they are ranking based, and when we typically talk about the typical credit risk models, we are not just concerned about the relative order. I also need the actual probability of default. Even the level of risk is very much crucial. So these two methods have some level of limitation from that perspective, right? Then, once we are comfortable with understanding the performance measures for misclassification, we are looking at the performance measures for predicting the reliability. So here we are more bothered about the posterior probability of the group membership, to which what is the probability that it belongs, that a particular risk belongs to a default group or a non-default group. So that is where we are trying to come out with performance measures which are targeting the prediction reliability, because the pricing of the output can be done quite effectively with that. If it is more and more probability, if it has a high probability of default, probably I can charge a higher interest rate and vice versa. So I really need a good accurate model which can estimate the probability that a particular borrower is going to fall into a default group versus a non-default group. And this is where we are using a maximum likelihood decision rule, in which we are following the geometric mean probability approach, where we are taking this kind of a formula e to the power of 1 by n time yi is talking about truly defaulting companies. Truly defaulting companies for which we are giving probability of xi. The model has given that the probability of default is xi, but in reality they have defaulted. And here we are talking of non-defaulting companies, where we are giving the probability of default as xi. So we are taking the companies which have a probability of xi, but they have really defaulted, and the probability of default is xi, but they have really not defaulted. Based on that, I am computing what is called as a geometric mean probability, and whichever the model is having the highest geometric mean probability, we are calling as the better model for if the target is prediction reliability. And along with that, we can also use various other methods to really find out which model is the most best fitting model for predicting the reality or reliability. Right, predicting the probability of default, which is the most reliable model. If I have to look at, we can consider even the Akai case information criteria, where we do the computation with -2 log likelihood that is coming from the maximum likelihood function. Maximum log likelihood is what I am taking, plus 2k. K is the number of parameters that I am taking in the model. The same logic, there is a Schwartz or a BIC, Bayesian information criteria, which is typically going with -2 log likelihood function plus k log n, which is n is the number of samples that we are considering. Here it has directly taken as 2k, but here it has taken as k log n. So this is where the number of samples is playing an important role here. And whichever is the one that minimizes the selected criteria, that is the one we are typically going to use here. So it is penalizing on the number of parameters. If k is large, here the penalty is only twice, but here the penalty is log n time. So BIC is actually penalizing for a higher parameters, more number of parameters heavily compared to AIC, and whichever the model is giving me the least value, I'll choose that particular value towards the targeting accuracy or the prediction reliability. And I can very well use the goodness of fit test, which is commonly performed using a chi-square, where we generally do the observed minus the expected whole squared by expected. I sum out across all the observations, and I say that this is going to follow a chi-square distribution with k minus 1 degrees of freedom. Right, so this is what we do as a part of the chi-square test. So we are taking the observed value minus the expected. So the expected value based on whatever the unknown distribution to a known distribution mapping. So if I assume that it's a binomial distribution, I am taking this as the expected value squared divided by the expected value. So analyze how close a sample is drawn from an unknown distribution, and how close I can map it to a known distribution. So it is measuring a normalized distance, and it assumes that it follows a chi-square distribution with k minus 1 degrees of freedom. But of course, though it's a decent measure to go ahead, it depends on the choice of the classes. How many classes I am doing? 2, 3, 5, 20. And it assumes that all the classes are independent. And there should be a reasonable trade-off between the number of events and number of classes. And it's also assuming that all the deviations are having the same weight. I am not applying any kind of weightages to any of the deviations here. I am taking a plain where it's equal weighted average kind of stuff. Now this is where I could see some limitation, but obviously this is also one test which we can do, which can talk about the model fitness, the prediction accuracy fitment. Or we can even talk about a Kolmogorov-Smirnov test, where I am classifying the various the data that is predicted versus the actual. So the predicted is based on some distribution. The actual is what is the actual data. So I am creating specific buckets. I am arranging both of them in the ascending order or a descending order, and based on that I am comparing the empirical with the theoretical distribution. I am ranking all the observations in some order, and based on that I am finding out the proportion of observations which are below each and every. So based on that I am finding out an empirical step distribution. Okay, in each of the groups I am trying to find out the proportion of the firms that are falling in each of the groups, and I am trying to compare this with the theoretical distribution like normal or something, and based on that I am assessing the goodness of fitment to that particular distribution. Again, more or less on the similar lines with a chi-square kind of a distribution, but these are the two tests that are very much helpful in terms of predicting accuracy. So when I am looking at any of these, in general, the performance measures, whether they are targeted towards prediction accuracy or targeted towards classification accuracy, the ROC is giving a good insight into type 1 and type 2 errors. So because of that, the bankers can very well target their default cutoff point and then do the comparison with respect to type 1 and type 2. They give a very good ranking order accuracy, whereas when I am looking at prediction accuracy kind of models, we can very well go ahead with the maximum likelihood, and they both used together can give a much better prediction, much better classification, as well as the prediction of probability of default. So just to summarize, if I have to select a specific class of models, performance is one criteria that I can look at. In that, I should not target a complex model. A complex model is something that I am choosing only if I am very confident that the detection or classification of a risky firm is much more accurate than a very simple naive rule. Only then I have to choose a complex model, and that is very clearly coming out with the test using the Akai case information criteria or the Bayesian information criteria, which are penalizing on the number of parameters that are going into the model. And I should also look at the defining the classification or the prediction as a goal. Do I really want accurate classification or prediction? Based on that, I can use the error rule appropriately, right? So, and even I can use the model appropriately. If it is more of classification, I can use a linear discriminant analysis or a logic. But if it is more of a prediction, I can talk about the support vector machines, or I can even look at k nearest neighbor approach kind of mechanisms. Similarly, one more attribute that I am looking at is the data availability versus the quality. Right? I mean, apart from looking at everything, the model should be able to handle the missing values and outliers. And probably a simpler model which is more and more robust is very much required compared to a state-of-the-art system which is having patchy data sets. So I have to be very careful in choosing my model. It should be very much understandable by the users. People should be able to make out what is the logic behind the working of the model, how it works, and how the results are typically obtained. I should be able to look at the robustness in the model. Probably just adding a few more elements and the model is becoming shaky. Right? So which means it is choosing more and more of a local optima but not a global optima, which is not a good attribute of a model. Just I add a couple of new data points, there should not be a significant change in the output that the model is trying to bring up. So that is the level of robustness I am expecting out of the model, which is another important attribute. And finally, the time that is required to calibrate or recalibrate the model. See, it has to depend on the frequency. If I want to run it every day, my model calculation should be much faster. Probably if I am using it once in a while, yeah, even if it takes a little bit extra time, it does not matter to me. So the selection of the model depends on all these different aspects. And just as a summarization of the performance measures, so first thing I will see whether I am interested in classification or prediction. Now, when I am more interested in classification, some of the decision rules that I can use, the Bayes rule, which we have already used, the probability of W1 given X1 multiplied by the probability of X1, or probably when I have to look at it, I am calling probability of X1 given W1 times probability of W1. That has to be maximized. Or I can take the help of Neyman-Pearson rule, which is more associated with, which is more and more associated with minimizing the error, type 1 error, without by keeping the type 2 error constant. That is what is being taken care by the Neyman-Pearson rule. Or I can look at the minimax kind of a rule, the maximum error that is possible or the maximum risk that is possible through any of the outcomes. I want to minimize the maximum risk that is possible. That is what is the minimax rule. So I can use any of these decision rules if my objective is classification. If my objective is prediction, I can go with the maximum likelihood rule or Akai-Case information criteria or the Schwartz-Bayesian information criteria, where we have used the formulas for both of them, and my intention is to have a minimum value for that particular criteria. So whichever the model gives me the lowest value for any of these criteria, that would be the rule that I am finalizing on. Similarly, I am going with user independent measures here, where I can look at the receiver operating characteristic, which is the ROC, or probably there are a few more models, or I can look at the GME, which is the cumulative accuracy profile. So I can choose, now we have discussed about these two models, so I can very well choose whichever as the model is more and more appropriate by looking at either the ROC, whichever model is more and more steeper based on the ROC curve or the cap curve. I can use that model to be a much better measure. So these are the user independent kind of measures. Similarly, when I am using user independent measures here, I can take the help of goodness of fitness test, which we are doing, comparing the actuals with the predicted, where we are depending heavily on the chi-square test, or probably we are even going with the Kolmogorov-Smirnov kind of test. So the chi-square test or a Kolmogorov-Smirnov kind of test is used here. And when the focus is more and more cost-based measures, because ROC takes into consideration the costs associated with type 1 and type 2 measures, I can very comfortably use ROC here. And here we have quite different kinds of measures which we haven't discussed in any while as a part of this session. But just for an understanding perspective, we can use any of these measures for utility base. So this is a kind of a quick summarization from the performance measures perspective. So that is the whole thing which I wanted to talk about as a part of this session. I think we have covered almost every aspect. Initially, we started off with structural models which are equity based, where we have looked at the Merton model and the KMA Credit Monitor. Then slowly moved towards the credit scoring models, where we have talked about the four major models: linear discriminant analysis, logit and probit, K nearest neighbor approach, and support vector machines. And after that we started seeing, okay, now that we have built different kinds of models, how do I really evaluate the performance of each of these models? How do I measure the performance of each of these models? So one, we have come out with the decision rule which we really want, depending on whether we are doing a classification accuracy or a prediction reliability. I'm more interested in a decision rule. And along with that, I'm also talking about what are the measures that I can use. So we have talked about ROC and Gini cap for the classification accuracy, and we are talking about the goodness of fitness test, chi-square test, Kolmogorov-Smirnov kind of test for the prediction reliability. And finally, we just spent a slide or so in terms of understanding what is the way we typically select a class of model, which class of model we have to use for what kind of a purpose. Thanks a lot for listening to this session. Thank you very much.